Betting against the market. Understanding shorting. Here we'll explore the strategy of shorting stocks and why it's a powerful tool for savvy investors. Shorting stocks is a betting strategy where an investor borrows shares of a stock from someone else and sells them with the hope of buying them back later at a lower price. If the price does drop, the investor can buy back the shares, return them to the lender, and pocket the difference as profit. While shorting stocks can be a profitable way to invest, it also comes with significant risks. If the price of the stock goes up, the investor can suffer large losses that are potentially unlimited. This is because the price of a stock can theoretically continue to rise indefinitely, and the short seller is forced to cover their position by buying the stock at the higher price. So why would someone choose to short a stock? Investors might short a stock as a hedge against their long positions, or as a speculative play when they believe a stock's price is overvalued and due for a correction. Shorting can also be used to take advantage of market trends or to profit from economic events, such as an earnings miss or a change in company leadership. It's important to note that shorting stocks is not suitable for all investors and should only be attempted by those with a high level of knowledge and experience in the financial markets. Thanks for watching. Subscribe to Finance Minute. Subscribe to Finance.